Whilst much of the world was in lockdown, financial markets continued to operate, often with spectacular results. And now as economies start to reopen, some of the greatest opportunities of our lifetime will unfold in the coming months and years. This is not a time to shy away from investment ideas. This is the time to embrace them and investigate their potential for our investment portfolios. We've asked experts from across a range of different markets about why we should invest in them and why now. In this episode, we're throwing the spotlight on precious metals. In a world of parabolic fiat money printing, investors have begun rotating into sectors such as gold and silver miners and the underlying metals. I spoke to Sean Fieler, president of Equinox Partners, to ask why gold and silver miners provide an opportunity for outsized returns and why now is the time to start investing.
I think the macro setup for gold is really perfect, and the narrative that the Fed has that basically everything was hunky-dory and now we have the corona crisis and therefore they've had to take these extreme measures, but if we can just get back to where we were, we're going to be okay, just doesn't hold water.
Central banks have been incredibly aggressive in expanding their balance sheets, but Sean thinks that policymakers may have painted themselves into a corner from where they will find it increasingly difficult to extract themselves.
The Fed's balance sheet's now over a third of GDP, up from 6% of GDP prior to the 2008 crisis. And they're not alone. And the really troubling thing is that there's no exit strategy. There's no strategy to get back to where we were just in 2007. And so I think we're stuck with much more active central banks, much larger central bank balance sheets, and more financial repression. I think we're just in the early innings of the financial repression that's going to go with those very active central banks. The new normal involves much less economic activity, and the recovery is going to be, I think, a long workout, and that's going to be, I think, aggravated in large part by a starting point of very aggressive both fiscal and monetary policy going into this. And so we had a $1 trillion deficit here in the United States prior to this crisis. We're on pace to be in the high teens, and looks like they're going to spend more and put us over 20% fiscal deficit for the year in 2020. I think it's increasingly unlikely that we're able to extricate ourselves from these historically very anomalous policies without some larger financial reset.
Sean also notes that economies have failed to fully rebound from the 2008 crisis, which creates an additional hurdle for this recovery.
If that 10-year plus of recovery didn't allow us to normalize, and now we have more debt than we had going into the 2008 crisis in relationship to GDP, it's hard to imagine what's the scenario whereby we get back to meaningfully positive real rates, just with debt to GDP on an aggregate basis well over 300% in many developed markets. These economies just can't handle meaningfully positive real rates, which really puts the central banks in a very vulnerable position if you do get any inflation.
Supply and demand dynamics play a key role within the precious metals and mining complex. Sean outlined the main dynamics that have been playing out over the last 12 months.
I see mine supply going sideways. It's been sideways, 3,300 tons for the last 5 years. I see that continuing. There's just a really long lead time in terms of bringing new mines into production. There's a lot mining companies can do around the edges on a year-to-year basis in terms of production and high grading and mine plan, but over a longer period of time, I just don't really see mine supply responding to higher prices in any kind of meaningful way. And we have, I think, what's going to be more relevant for most investors, both in gold and silver and in the mining companies themselves, is we just had a lot of tightness in the market. I expect both capital expenditure and exploration budgets to start ramping pretty quickly as the metal prices increase here. But these budgets were cut, more than 70% coming out of the 2011 highs. And the geology has not really cooperated. You haven't had those 5 million ounce plus discoveries in this for decades. So it's been a challenging environment for the miners over the last 7 or 8 years, in large part due to the weaker commodity prices of both gold and silver. But as that reverses, I suspect they'll spend more, but I don't expect that will result in much in the way of incremental production.
I was Sean about the impact of central banks who were major participants in the precious metals markets during 2019, and also about the influence of retail investors via ETFs. The size of the silver market makes it particularly sensitive to new flows.
Central banks are largely out of the silver market physically, from what we can tell. 2019 was the largest year in 50 years, really since the late 60s, in terms of central bank gold purchases, close to 700 tons last year. This year, we're expecting a downtick from that, somewhere north of 400 tons, but significantly less than 700 tons. Russia claimed it was going to stop buying at the end of the first quarter. That didn't happen. They've continued to buy. We're still in a market where central bankers are, on a year in, year out basis, acquirers of large fraction of the world's gold production, unlike what we saw going into 2008, where they were still sellers. There's an irony there in that central banks that are ostensibly, so confident in their own alternative to gold are, in recent years, becoming the single largest buyers of gold. The ETFs are the easiest way to see the retail demand. And there you've got 250 tons go into the GLD in the second quarter of this year. I think the inflows into the silver ETF are even more problematic, and just there's a much smaller amount of above ground stock of silver than there is of gold, and it's a much smaller market. So you're talking about less than 1 billion ounces a year of total mine supply in silver, so less than $20 billion market on a per annum basis. And when you start to see a couple billion flow into the ETF on a single quarter, it gives you a sense in terms of how hard it's going to be for the market to accommodate those kind of inflows if they're sustained for any meaningful period of time. And I think in silver you see a metal that has really a possibility to appreciate much more dramatically than what you see in gold at this point.
The fundamentals for miners within this sector have improved. I asked about the current outlook and how it compares to the previous cycle during the last decade.
This is an industry that, for the most part, has very little debt. Certainly, the juniors have very little or no debt. It's a cyclical business with a lot of uncertainty, and so it's not amenable to much in the way of leverage. And then you have now an environment that in many ways is better than the commodity cycle we had going in 2000 through 2008, where you don't have the appreciation of base metals the same way that you did in that commodity cycle. And so you really have an opportunity for expanding margins as energy prices here are much lower than they were in the midpoint in the last cycle. And a lot of the inputs and contracting costs haven't moved the same way they were in the last commodity cycle. So I think we're seeing some really nice margin improvements right now with the higher metal prices, and I think absent a synchronized global recovery, we're likely to see those margins continue to expand pretty dramatically.
Sean talked about some of the challenges that investors face within this sector, and I asked him to highlight a couple of names that he preferred.
No two mines are the same, so there's just a lot of legwork involved. You need to know the geographies. Having run a emerging market and frontier fund helps a lot in terms of knowing the political context in which most of these mines are operating, and having invested in a lot of these geographies in the mining space itself through other companies. And then the people, right? So most of the industry is run by middle-aged guys, some middle-aged women, but they tend not to change. So the bad actors kind of remain bad actors, and the better actors better, so long as they have the right governance structure and leadership around them. So we spent a lot of time trying to solve the agency issue where insiders have interests that are divergent from minority shareholders, and then we spent a lot of time focused on the quality of the underlying assets and their management team's ability to execute on their plans. Endeavor is a larger miner that we really like. So they produce about a million ounces a year, so it's the 15th largest gold mine in the world. It's a West Africa-based mine, geographically speaking. And you have one principal shareholder, Naguib Suarez, who owns a little over a quarter of the company. And so you have no agency issue, and you really have a great demonstrated history of there being one of the very best actors in West Africa. They have good financial strength, good assets. They were able to take advantage of the crisis by buying Semifo, another company that got into distress earlier this year. I think on a lot of levels at NAV, it's surprising that it trades at such a large discount to some of the very largest companies, given their really strong track record of execution and the quality of their assets. Bluestone is another company, so this also doesn't have an agency issue because it's controlled by the Lundin family. And Jack Lundin just came over as CEO from the Fruta del Norte project in Ecuador, which they'd successfully permitted in what is a difficult geography. And so we're quite hopeful that he's going to be able to get through the permitting and financing process in Guatemala, just like they were in Ecuador. And this is a company that trades at less than half of NAV, despite some very high grade and some really high quality management and shareholders.
There are a number of tailwinds at play at the macro level, such as the monetary policy adopted by central banks, whilst many of the underlying mining names have appealing fundamentals. Sean summarised why this whole sector looks like an exciting prospect right now.
Central banks are boxed in a way and to an extent that they haven't been at any point in my lifetime. And you see that in the how extreme their behavior is. They're doing things they never did in 2008. I mean, the idea that the Federal Reserve is going to buy the debt of Illinois is so beyond crazy. And it's not as if the Illinois is reforming to get the Fed's money. So they're really, I think, way out over their skis from a policy perspective, and they're not alone as a central bank in doing that. So I think that sets up very well for the currency that no central bank can print. And then you add to that all the obvious stress that we see in the physical market of both gold and silver this spring. You can do it at a time today. You can buy the miners at a discount to NAV, despite really the physical supply demand of the metals and the macro setup being about as good as you can imagine. Despite the success of the Paulson funds with the proxy fight and takeover and then sale at 100% plus premium of Detour last year, we still see really almost no activists involved in the space. I suspect that'll change at some point. And I think the focus on governance and our focus on governance and the way in which capital is reinvested is going to become a lot more important as these companies have a lot more capital to reinvest in a higher metals price environment. And so I think investors, just like the last cycle, should see this cycle as an opportunity not to just trade these companies, but really to partner with management and the boards over a long period of time. And there's relatively few boards and managements that you want to be full cycle partners with in this space. And so I think that's where we do a lot of our work. I think that's where there's a lot of work to do, and that's where the industry really hasn't changed since the last cycle that much. We get clients asking if they missed it, right? Because now the GDX or GDXJ, if it's up 20% or so on the year, is it over? And if you look at the last cycle, I think this has several years to go. We got to real extremes in terms of the relationship between hard assets and financial assets, and especially between gold and silver and financial assets. And so I think we're going to have several years where this re-equilibrates, re-normalizes in terms of the price of gold and silver in relationship to other financial assets. The last go round, we saw many of these companies go up 10 times. I think we could certainly see that again, certainly given the low valuation that a lot of these companies are starting.
Precious metals such as silver and gold have a strong macro tailwind from the central bank printing presses, but there is still no credible exit strategy, and balance sheet expansion is expected to continue. For the miners, fundamentals are also very attractive, but these are names in a relatively illiquid sector, especially silver. It doesn't take much to move these stocks, but institutional investors are engaging in this space, and that could drive outsized moves over an extended period of time. So if you haven't looked at precious metals and the gold and silver miners before, now is an excellent time to do some homework and look at the individual names that offer the most exciting prospects in this space.